I know in the last panel, Gloria mentioned the word recession. So our next panel, we're going to have Rachel Rothman, who is head of hotels and research and data analyses for CBRE. She's going to be talking about, with her panel, predicting and planning for a recession, which is a timely topic that we have. They'll be out in just a moment.
All right, let's see if the mic's on. Just before we get started, I wanted to give a shout out to Sharon, to Barack, to Patty, to Kaylee, to Aaron, to our MC Patrick. Fabulous job. It is a really high bar to host a luxury conference and to make everything so smooth and seamless. My heart goes out to you. Thank you for this opportunity. Also to the staff here at the Biltmore, perfect execution. Thank you all. There's been a lot of talk about luxury. I also want to point out one thing that makes this conference different is the level of seniority of the attendees. Last night out at the cocktail hour and at the dinner, I had the opportunity to talk to so many people. I was impressed to notice that the most junior person I found had 15 years of experience. With that, 160 years of lodging experience on this stage. Gentlemen, one by one, please introduce yourselves and what you do.
Yeah, go ahead.
Oh, thank you. Good morning. My name is Zach Demuth. I'm the head of America's Hotels Research at Jones Lang LaSalle. So I lead our Insights and Trends division. So we focus on trends across the entire lodging space, investment trends, performance trends, et cetera. And I also help advise our clients on how to maximize value for their existing hotels or portfolio, as well as opportunities for strategic acquisition and disposition. And I have a strong affinity to luxury. Prior to JLL, I worked for Ritz-Carlton for over a decade in corporate strategy and distribution. So very excited to be here, and thank you, Rachel and ILHA.
Great. Welcome, everybody. I'm Dave Tessier. I'm the founder and CEO of Hospitality Gaming Advisors. We go by HGA. We are hotel developers, mostly in the luxury lifestyle. We do W, Edition, Belmont, or some of the hotels that we've done. We just opened 2 hotels at the end of COVID. One was the W Nashville. We also are a boutique advisory firm. We do a lot of larger, more complicated projects, a lot of gaming projects. Currently, our biggest client is the Public Investment Fund for the Kingdom of Saudi Arabia. We've been doing a lot of work out there in Saudi Arabia on some of the mega projects.
Good morning. My name is Jonathan Falik, founder and CEO of JF Capital Advisors. We're just under 20 years old. We focus on strategic advisory and capital markets advisory work for hospitality and hospitality mixed-use projects. We've completed about $35 billion of transactions, including public and private acquisitions, dispositions, restructurings. We've made investments in 25 hotels in a sponsor, GP, or managing member capacity. And if it's complicated around hotel structure, we work on it.
So we're here to be of service for you. If you have any questions at any time, feel free to just raise your hand and interrupt. Please leverage their expertise. As you guys are out in the market advising your clients, today RevPAR actually has never been stronger. What lens are you guys looking through for 2023 and beyond? What is your forecast? You don't have to give a number, but how are you feeling and how is that influencing the advice that you're giving your clients? Let's start with you, David.
Yeah, I think you look at it 2 different ways. One on the development standpoint, the other on operations. I mean, I think in development, this is kind of an unprecedented time where you've got some very serious headwinds. So right now we're saying if you're self-funding, you don't need financing. If you self-perform construction, especially if you're affiliated with a construction group and you don't need a GMP, you know, those are the guys that should be out there taking advantage of this situation right now, because you really have so many hotels in a holding pattern kind of planning right now, and people can't execute because of the capital markets and other economic factors. So I think from that standpoint, we really encourage people that have that capability to be out there. And from an operations standpoint, you have an all-time high RevPAR, which is amazing, but you also have all-time high costs,
Yes.
right? Cost of labor is not turning around, and your fuel costs of fuel, basically everything, all other costs are high, based on fuel. Supply chain's getting better, but with all those things are being hidden now by this unprecedented high average rate. But average rate can fall, but nobody turns back labor costs, right? So we're advising everybody just be very, very cautious with your margins right now because average rate is probably unsustainable.
Jonathan?
I'll follow up on one thing that Dave said and then add a few more. One is we get all sorts of reporting and discuss RevPAR growth and what's the RevPAR and how do you comp to last year, how do you comp to 2019. The reality is most of the data that we're seeing and most of the data we're focusing on is on nominal RevPAR growth, not real RevPAR growth adjusted for inflation. So in the last 12 months, we've experienced just under 8% CPI growth, essentially 8% increase in inflation in certain areas higher and certain lower. So if you normalize or adjust the rates that we're looking at right now, which look tremendous, and in certain resort markets look tremendously high, they're not truly as high if you adjust for inflation. That's one. Two is if you went back to the beginning of this year, to January of 2022, you would find the 10-year Treasury hovering around a yield of around 1.6%, not between 3.5% and 4% as it's been now. You would have found 30-day LIBOR, short-term borrowing rates, or 30-day one-month forward SOFR rates at 15 basis points, 16 basis points, so 0.16%, and now you're finding them over 4% and projected to go higher. So any forecast that we're doing, right, we don't know. We don't know. And as a result, in doing all the budgets, so we're involved with asset management and ownership of a whole bunch of properties, all shapes and sizes, all around the country, we spent far less time doing budgets for 2021, 2022, and now for 2023 than ever before. Because whatever budget we print, we know is wrong. We know the inflation landscape is different. We're watching corporate layoffs coming, not to sound like gloom and doom, but our title is Predicting and Planning for a Recession. Even though we're not seeing it in the operating trends numbers yet, like we're preparing for it. So our budget meetings are strategy sessions about how are we going to pivot? What are the contingency plans going to look like? We don't care as much about what's in the printed budget, but we think 2023 across the United States is going to be more challenging than 2022. There are certain markets and sub-markets that will be outliers, but we think it will be more challenging, and that's our lens.
Zach?
Yeah, I mean, I think Jonathan hit it. For us, really, all eyes are on the debt markets, right, and the at best volatile constraints that we're in. Yesterday, of course, the Fed announcing another 50 basis points increase. And to Jonathan's point, depending on your market, depending on your asset, you might be looking at all-in coupons of 500 basis points or 5% greater than they were beginning of this year. And you're talking about, resorts obviously generally recovered or exceeding 2019 performance, but many hotels, particularly in urban markets, still not yet recovered, potentially have drained all their FF&E reserves in order to just make payroll, and now maybe refis are coming and you just can't afford it, right? So what does that look like? I think for us, though, we look at it as an opportunity. We think 2023, looking at an investment perspective, really creates an opportunity for buyers, to Dave's point, that maybe are less reliant on the debt markets, lower leverage buyers, and we've really seen that in the luxury space over the last month. The 3 strategic hotels all traded in the $1 million plus per key, almost $2 million per key, and we think there's going to be opportunities like that moving forward, again, with a very specific buyer pool, because a lot of owners are going to have their debt coming to maturity, going to be a lot more expensive than it was previously, and that will create catalysts for acquisition and disposition.
So historically, there was a very strong relationship between GDP growth and hotel demand and RevPAR. That completely disconnected this year. And I think most economists are calling for some sort of GDP decline next year. Are you guys thinking that the disconnect will continue? Is there the possibility that we will see still increasing demand and increasing RevPAR, even in a decelerating or recessionary environment? And then what markets do you think would be winners, or what types of assets in that environment?
So I've got a 3-hour answer to that, and I've done different lectures.
I have another 2 to go
Our
on
shot
top of your
clock is
3.
wrong, but it's not wrong by that much.
I'll start by saying that there are so many external factors that are manipulating, right, everything that we're looking at. We've never had the amount of stimulus, of monetary and fiscal stimulus on such a short-term basis than we've seen over the last few years, and it keeps coming, right? Just things as simple as postponing repayments or monthly payments on student loans, right, creates a borrowing and puts more money in the pockets of the holders of those student loans, right? Rent moratoria. War. No one a year ago was really predicting a war between Russia and Ukraine, right? There's so many external factors that are screwing up some of the historical metrics and relationships that we look at over a longer, more stabilized period. Yes, there should be a natural correlation between GDP growth and RevPAR growth, between capacity utilization and RevPAR growth, generally speaking, between higher interest rates and higher RevPAR growth, because higher interest rates means there's more demand for money. You need a higher return on money. People need to pay higher for room rates, higher for restaurants. So I think you'll see some of those trends normalize, but there's so many things in the interim that are influencing them, and you've got to get much more market specific, because the dynamics that are happening in a state like Florida that was open as pro-labor might look a lot different than the dynamics in Los Angeles, where they're talking about reimposing an indoor mask mandate, right? And what is that going to do to hotel demand? And the one other thing I would tell you is we had this very weird period where some types of travel were forcefully closed. So in the last 6 months, I bet a lot of people in this room have been on some sort of international vacation or a trip or a business trip. Some have been on a cruise for 2.5 years before that. I traveled about 10% as much as I normally would internationally, only for family events overseas. Starting 6 months ago, I was traveling all over the place. Starting a few months ago, I was on a luxury cruise. So things that were shut down have reopened. And the last piece I'll say before I turn it over to Dave for his 2 hours is, in the end of 2020, when you look at the payroll providers, the Paycom and the ADP data, there were bigger data banks, right, data repositories of unused vacation time and sick days because professionals were working remotely. So even if they went on vacation and they came from the Northeast to Scottsdale, Arizona for 2-3 weeks, they dialed into their Zoom calls for a few hours, they wrote their emails, and they were on vacation with their family but didn't use a single vacation day. So that accrued, and a lot of it rolled over, and there was a lot more demand for leisure travel and a lot more ability to spend domestically because people weren't going internationally. They weren't doing some of the vacations, some of the camps that their kids would do. They weren't buying as many new vehicles. So we're seeing some things normalize as a lot of professional services firms, real estate firms, banks are pushing, even tech firms now are pushing people back into the offices, right? And that's going to impact to some extent the leisure, the real growth in leisure that we've seen. It won't take it away. It won't take it away, but that's a countervailing force that we've got to be very careful watching, because some of the vacation patterns in 2023 will not necessarily follow the factors that we saw in 2022.
Great. Well, I agree with 90%. what you said.
What 10% do you
But the
disagree?
10%, well,
Yes.
Focus on the 10.
Let's focus on the
so-
10.
no,
but
Let's
I-
debate, ladies and
No, but
gentlemen.
I think
Let's go. Come on.
yeah, you ready? Okay. I think I'd like to go back to the beginning of your question, right? Is that the disparity between GDP and RevPAR? That's been a 30-year correlation, right? And we're in a cyclical business. Everybody knows we're in a cyclical business. But what typically has driven these cycles, right, are liquidity. Savings and loans, loaning too much, and then all of a sudden everybody figured out, okay, that's a mistake, shuts it down, and that goes. You know, the credit enhancements, you know, with CMBS financing was going crazy because you had credit enhancements, you had credit default swaps where you were over lending, right? So that caused way too much supply and demand, all that crashed, right? So typically over the years you've had these natural corrections, and that's one of the reasons GDP and RevPAR have always kind of been correlated. And this is kind of one of the first times you've had a correction that's not due to liquidity in the market. It's not due to supply and demand. It was due to a pandemic and government-imposed shutdowns. And so you're kind of coming out of that this time. So you're not dealing with the oversupply. You're not dealing with, you know, all these hotels that have, you know, were funded and going, you know, the pandemic shut things down. I think in the third quarter, we have the most hotels under planning that we've ever had worldwide. And that's not because everybody this year has decided to put hotels in planning. That is because from the end of 2019 till now, everybody's stuck in planning and nobody's able to execute, right? So I think you've got this kind of false RevPAR growth that's a rebound of, to your point, you know, you had people banking, you know, group deposits they had to use. Sure. You had, you know, delays in weddings and delays in family reunions, and you had you know, pent-up leisure demand, especially in luxury and resorts, right? So all that, you know, you're getting all the benefits of this, you know, pent-up demand, and you're getting the benefits of some of this recovery. And I think as the economy worsens, 2023 is going to be a very interesting year. I think in the long run, that correlation is going to come back.
Which 10% did you disagree with?
To be honest, that was a really long question, and I almost forgot.
Okay. No problem.
But you did a really good job answering all parts of the question. I don't recall all the parts of the question, so I'm going to stop there.
Well, I'm going to actually disagree with even more of both of
Disagree,
you.
but
Yes.
talk about interest rate, foreign exchange rates as
Foreign
well.
exchange, yeah.
That's a huge issue for us too.
Agreed, but I think, you know, we're at a luxury conference, so really to zero on the luxury space, you know, I heard at the earlier panel someone say recession-proof. I don't think anything's recession-proof, but recession-resistant or more, you know, more protected. I think we really have to focus on, and Jonathan a little touched on this, the amount of money that consumers have saved over the past year. If you look at bank accounts across the U.S., Bloomberg releases reports regularly. Most recently, they showed almost $5 trillion in savings. That's up $1 trillion from this point last year and up similarly versus 2019 levels. You add to the fact that there's more high net worth individuals than ever before, not just here in the US, but globally, Middle East, Europe, Asia Pacific, and then the dollars that those individuals have saved continues to escalate. You know, we see and we just heard about the trends in branded residential and how that's exploded, obviously caters for a very specific crowd. And I think all that said, and really focusing specifically on luxury, we'll see 2023 growth in that segment. We're already continuing and seeing more and more investment into the luxury segment. Again, most of the buyers are not reliant on the public debt markets, generally speaking, either all cash or have their own credit facilities, and therefore able to continue to buy at these, you know, astronomical valuations, $1 million, $2 million a key. And I think, again, some market exceptions will continue to see growth from a RevPAR perspective, average rate perspective, and profit. You know, the other viewpoint I take, and to Jonathan's point about foreign exchange, you know, the dollar continues to strengthen. What does that mean? You know, the negative viewpoint is that means Americans likely will travel overseas, right, to take advantage of, you know, the strengthening dollar versus the pound versus the euro versus the yen in Japan. So that'll be interesting, but I think from an investor perspective, that also offers opportunity. If you look at the global luxury market, I think, you know, Asia, Singapore, Japan, Hong Kong, I think you're going to see a lot of liquidity head there as well, and that ultimately just lifts, you know, the global luxury market.
Can I follow on just one thing that
Absolutely.
Zach just said? So Relevant to this room and this conference, a lot of that massive amount of savings we're seeing is concentrated at the higher end and the highest end. It's not an equal distribution throughout the economy. So that bodes very well, for prospects in the luxury market, right? Because the top 1%, the top 5% are generally not traveling and staying in comfort inns and La Quinta, inns and suites. They're staying in somewhere starting at the upper upscale level, going straight up into luxury, and are comfortable enough spending those dollars and those rates. So they have the dollars to do it.
I think Zach was bringing up a great point. I think luxury supply is maybe 6% of total hotel supply.
Much less.
Maybe.
Much less.
Depending on how you define
I
it.
guess it
Depends who you're
depends on if you're talking about a traditional.
If you look at the STR census, I know
Right.
they're not as good as your firm, right? But if you look at the STR census, what they classify as luxury, that's not a bad plug, right?
It's okay. We love
What
everyone
they
here.
classify as luxury is 0.7% of the overall 63,000 hotels in the United States, and that accounts for about 2.25, 2.4% of the overall room count. So it's a very small portion of it. When you look at revenue spent, because the ADR is much higher, the
Higher,
non-room
yeah.
spend is much higher, that's where you get up to closer to 6% on an all-in spend. But it's a very small number. It's a very small number of properties when you get into what is the definition of luxury in the U.S. And then to the point Dave made earlier, if you're trying to build a budget hotel, you might have a 2 to 2.5 year period from pre-development, design, planning until you're open. If you're building an urban or a high-end, resort luxury property, probably the shortest time you can do that is 6 years, 5 years if everything is wired. Anyone who isn't convinced about that, talk to John Keeling afterwards about how long it takes to develop a luxury product. And in some cases, it'll take 10, 15 years, right, to get through all the environmental approvals, to get through everything. And when you get there, you might be in a set of capital markets like today, where the debt financing cost, construction financing is difficult, and people are coming. I think there will be more sessions and more conferences in 2023, with titles like, what do we do in a recession, or what do we do in a challenging market? And in some cases, the pure operations will be fine, but the capital structure will not be fine, right? And someone who can't figure out how to refinance their mortgage loan is not reinvesting in the property.
Agreed. Before we switch to capital markets, David, I know that one of the reasons people go to advisors that have been around for decades is because they have steady hands in a crisis, because they've navigated several cycles. And in the last 35 years, we've had 4 cycles. How are your clients, particularly since you deal so much globally and internationally, how are they viewing the industry? What are they thinking of? What are they attracted to most about hotels, and how are they positioning themselves?
So I think this is a perfect conference for this, right? Because everybody looks at luxury, lifestyle luxury, being the smartest place to put your money, because travel trends are getting more curated. Mm-hmm. People are looking for a specific experience, and they're willing to pay for it. And what we're doing in Saudi Arabia right now are all super luxury projects. So Diriyah Gate, they have 30 hotels, I believe, down. We have one of the 30 hotels does not fall in either the hyper luxury or luxury, right? So people are investing that, and to your point, it's a very small part of the market, mm-hmm. and it's the highest growth in the lodging industry is within luxury, right? So I think, most of what we're saying is stick to something that's unique, and the type of we're using sovereign wealth money right now, so obviously we don't have the issues that are coming due. Well, the mortgage is coming due. I think, one of the things we all have to consider is coming out of COVID, lenders extended loans. Mm-hmm. They extended a lot of loans. Loans became to maturity, and if it's CMBS or balance sheet loans, everybody, these people were not able to pay off their loans, so they refinance. Think about how many deals got done and how many loans got done over the past 10 years where people penciled a 70%, 75, 80% leverage in some cases, right, on a 4% interest rate. Now take that, whatever their EBITDA is, and then try to say, how much does my EBITDA have to grow to refinance that now with a 7% interest rate? So
And what's
there's
the capital call in between, right?
yeah, there's so many properties out there. There's a ticking time bomb out there right now with all these mortgages coming due. And don't think money center banks, even if somebody wanted to lend that, they're all regulated.
Right.
And they all have concentration issues, and the concentration issues that they have right now are in hospitality. So, you've got this lack of liquidity for lending, coupled with the higher interest rates, coupled with all these extensions coming up. So I think in our industry in general, for as much as we want to say it's fantastic for luxury hotels, which I think it is, I think, especially internationally, you're going to have just a lot of maturities coming due, and you're going to have a lot of people that, developers and hotel owners and investors that, we're looking at this period of super low interest rates and feeling that was sustainable. And look back over our careers. I mean, 4%, fine. I mean, when was the last time you would pencil that on an IRR, right?
In 2007, before Lehman imploded, before Bear Stearns imploded in 2008, 30-day LIBOR was north of 5%. Right now we're aghast that we've come up to approaching 5% during 2023, and we're shocked. Now what's happened is rates have shot up faster than almost any time before. So to Dave's point, whatever underwriting you did, right, even if it was a conservative underwriting, the refinancing assumptions are lower leverage, higher cost, and a lender underwriting, less robust EBITDA growth than you think. And it's challenging, and the money center banks are mostly out of that lending and refinancing game because they're not getting paid off on existing loans. If they don't get paid off on existing loans, they can't put money back out. What they're lending to right now is their biggest, best clients with guarantees and personal recourse guarantees tagged on to some portion of the loans, and that's not a normal functioning market. So interest rates will stabilize somewhat, but it's highly unlikely that you're going to see either floating interest rates or the 10-year Treasury come back to where it was a year and a half ago. It's going to settle somewhere probably halfway between where it historically over a long-term period had been and where it is now. So that'll create some relief, but it doesn't really work. I'll say one more thing and then pass it over. During COVID, we did 26 property level restructurings where we were restructuring the debt, bringing more equity. Only about a quarter of those did we have clients that we had put in meaningful amounts of new equity and created a new 5 to 7 year debt structure. The vast majority of them were, we'll put a few $1 million in, you lender accrue some interest, you brand, let us raid the FF&E reserve, relax some it was basically sort of everyone give a little. And if you remember, we were staying at home for 14 days to stop the spread, and that was in March of 2020. Soon we'll be in March of 2023. And anyone who 2 years ago or a year and a half ago was doing a restructuring, putting more money in, thought, okay, I need a year and a half, 2 years, maybe 3 years max of time, and we're going to refinance. And there's this cascading wall of debt maturities coming, both stated original maturities and extended maturities, and there's enough liquidity there on the sidelines, but people are going to buy assets either from lenders, or you're going to see more foreclosures. We're seeing more and more of those notices where a year and a half ago, you weren't seeing that many foreclosure notices. You weren't seeing as many bankruptcy filings. We're seeing more every week. And that's going to continue as a trend throughout because you'll have underlying reasonably fine performance or recovering performance, but too much debt.
Right.
So I've got 2 more questions. I'm going to go to Zach for a complete answer, and then we'll go fire round for the second, and then I'm going to come to you, audience. So Zach, working with and representing one of the largest hotel brokerage firms, most respected, what deals are getting done? How are they getting done? And what are you suggesting that people focus on?
Yeah, I think it's interesting. It's almost like a tale of very 2 different cities. On the one hand, and I referenced it earlier, we are still seeing what I'll call trophy, irreplaceable, luxury assets getting traded. I mean, the 3 strategic assets that just got traded, Montage, Laguna Beach, obviously the 4 Seasons here in Scottsdale, those were sold either in the Montage case to an all-cash buyer, essentially high net worth individual, or here in 4 Seasons, Braemar, which is a REIT. Right, so those are, again, luxury assets, and they're getting acquired by buyers that have a lot less reliance or no reliance on the debt markets. To Jonathan's point, even if you have phenomenal performance, and I would imagine both of those hotels are performing extremely well, the debt, if you had to go to the debt markets, you would require a lot less leverage and a very high interest rate, likely not enough to cover. So those hotels are still getting traded, and we still see a lot of interest in those hotels. But again, it's a very specified buyer pool. Dave works closely with PIF. I mean, they're an example of a very specific buyer pool that can often afford those types of hotels and don't have to rely on the debt markets. On the other side, on the more economy budget side, which of course is outside of this conference, we are seeing smaller check size deals get done. The sub $20 million deals. Similar like La Quinta budget type hotels, and those, while they are relying on the debt markets, often more relying on local banks that can be a little bit more diligent, take more time, and you have more opportunities there. What we're really not seeing as much of is the 25 to 50 and 50 to 100 million dollar deals, which in the U.S. historically have been 60 to 70% of total liquidity, and that's because those deals require some degree of debt, and obviously it's quite expensive. That said, deals are getting done. It's depends on the asset. It's very, very dependent on the asset, very heavy dependent on the location and what the future performance looks like. I think what's interesting and encouraging is that, resorts obviously have dominated the conversation for the past, 3 years. I'm really encouraged and really bullish on the urban markets. We're starting to see a return to urban. While maybe not at the same degree that we'd all like, cities like New York, Washington, D.C., Chicago, Los Angeles, Nashville have really started to see an acceleration of recovery. And I think investors look at that as an opportunity because assets in those markets are often trading for discounts relative to pre-COVID levels. And therefore, if you have enough cash to sustain, maybe another 6, 8, 10 months of lower performance, the long-term opportunity is phenomenal. And I think that's what we're seeing as a real opportunity. And we are seeing, those deals get done. And I will say, if you look at liquidity this year, despite all of the volatility and the dislocation, in the U.S., we are trending at nearly an all-time high. Through Q3, total transaction volume in the U.S. Was up to last year and was down only about 20% to 2015 levels, which is the benchmark year here in the U.S. So again, we had a really strong first 6 months. Obviously, then the Fed started its monetary tightening and everything sort of went into disarray. But we're still seeing deals. We're seeing large portfolios. Brookfield bought Watermark Lodging Trust for almost $4 billion, all luxury assets. Ritz-Carlton's, Independence, et cetera. So those deals are still out there. I think they're just taking longer, and there's going to be some period of dislocation. But to Dave's earlier point, everything reverts to the mean eventually, and I think maybe it just takes a little bit longer, but ultimately we will see that occur.
Yeah, I think that you're right about liquidity, right? And we developed the W Nashville, opened it on October 6th, and I went to NYU in November and said, this is the time. I'm going to sell this hotel, and I'm only going to talk to REITs, because at that point, REIT stock was at an all-time high, and they were all out raising cash. I think a lot of the things that you see over the past 12 months, these record sales, right, were from REITs getting really cheap money and having to put it to use. And you know, I sold my hotel for $950,000 a key, almost $1 million a key in Nashville, Tennessee. The next closest sale was $500,000 per key.
Amazing.
You know, we just knew that first quarter, you know, through this year, you had a tremendous amount of liquidity, especially with the REITs. I think you're still going to have, to your point, sovereign wealth funds. You're still going to have, you know, certain, like white lodging, for instance. White lodging will, whatever time they're a cash buyer, right? Ocean Properties, right? White lodging, those large private firms, they're always going to be out there able to take advantage of something in this situation. I do think these are, the transactions we're talking are sales transactions. I think when you start looking at, I'm going to build a hotel, I'm going to put a shovel in the ground, now, and you got to get a GMP. And I don't care who you are, if you're going to put a shovel in the ground, you're going to want a GMP. Can you imagine, with supply chain issues, labor shortages, right? Steel up 40% from 2019. Cement up 42% since 2019, right? Still uncertainty about energy prices, right, going forward. So I'm going to have and with the supply chain and labor, you know, where I used to get a GMP that said, you know, I get liquidated damages after 28 months, you're not going to get liquidated damages from somebody, you know, it's going to be 4 years or something. And the GMP is going to have an escalation of 25%. So that cost, forget about the cost of interest, right? Because the interest that you're going to be paying on your debt financing is really going to be a small amount, right, compared to all these other costs of construction and development. And then you got to underwrite it, right? So going forward, that EBITDA now is going to be hit by, you know, maybe a 70% increase in debt service from what you were able to do 2 years ago. Throw that on top, and then have your lender take a look at you and say, okay, well, I'm going into recession, so I'm taking 15% off your projections. So now my projections have fallen literally by 15% plus the difference in interest rate. I've got, you know, 60% of my cash flow to try to get a project done that's 30% higher in cost.
And
so,
5 years out.
Yeah. Yeah, so I think we got some serious headwinds in ground-up construction. No matter how you look at it, no matter how much liquidity you have, I think you just got some serious headwinds in ground-up construction. I think, you know, there's some positive things in our economy we can look at. You can look at Japan and China. Used to be number, you know, I think it's Canada, Mexico, UK are the top 3 markets, and after that was Japan and China. Japan and China aren't even in the top 10 anymore. Yeah. So when that starts to recover, I think people go back to offices. I think you are going to get, I think our industry is going to be stable. And I think you're going to find that 23 and 24 might be still pretty strong in the hotel industry because you've got increasing demand coming back, and you're going to have a lack of supply from ground up. It's just not going to happen.
We started a couple minutes late, so I do want to allow the audience to ask any questions. Patrick, if you could help me facilitate, that would be great. Gentleman in the front.
Yes, coming.
Good afternoon. Thank you very much. I totally appreciate it. Thank you, Mr. Rothman. My question is, my name is Ghassan Sadr. We specialize in non-performing hotel loans, and we manage the properties. In your opinion, what was or still the relationship between the brand and the management company? Is the brand helping during pandemic, the owner, or they are not? And I'm talking about all brands. Thank you.
There's no right answer to that. It's a situation-specific analysis. Which brand, which manager, you know, how much additional distribution and supply does that brand have in the market? And then even beyond that, you could have the greatest brand, you could have the greatest management company. If the owner's not funding capital to maintain the property or isn't approving a budget where you're going to have the right staffing, you could have the greatest resources in the world that can't be deployed properly. So it's a mix of everything, and it's very situation specific.
I mean, brands are expensive to start with, and you're there for a loyalty program and distribution. You're not there for brand management. third-party management, that's why franchise hotels are so popular, right? Because third-party managers tend to be more nimble than brand managers. I think during this pandemic, some luxury travel preferences have changed. I think you have more people booking directly through hotels because they want to curate their experience. They want to, they have time, they have a longer stay, they're working from a hotel, maybe they're taking they want something experiential, they've been locked in their home for so long, they want to get out and get something experiential. They've got a little bit extra money in their pocket because from working from home, I don't have childcare, I don't have commuting costs. I don't have laundry, dry cleaning, my wardrobe, and all the different costs that go along with having to be in an office, so they've got a little bit more disposable income. And I think, because of that, you show that people are kind of going towards the luxury and going towards luxury lifestyle and trying to get a better product. And to do that, they're a little bit less concerned about price, and they're a little bit more concerned about where they're going, right? So
I think you also, if you look at it from the investment perspective, there are, of course, exceptions, but generally speaking, branded luxury hotels sell for more than unbranded. And I mean, their data has shown that both historically, during COVID, and I imagine moving forward. Again, some exceptions, of course. There are, of course, iconic independent luxury hotels that will sell, and if they ever sell, will sell for very high rates. But generally comparables within specific markets, branded hotels sell for 10, 15% more than unbranded hotels. On the luxury space specifically.
And they get financed easier, right?
Yeah, exactly.
Yeah.
Banks are a lot more comfortable financing a W than an unknown independent.
Right.
Hopefully you've gotten some exposure to the depth and breadth of their expertise. Feel free to network with them after the event. Thank you so much. It's been my pleasure. Thank you, gentlemen.
Thank you.